This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Stocks gain as Fed Chair Jay Powell says he still expects US interest rates to fall this year. Meanwhile, investors are on watch for a rate decision from the ECB today. The $8 billion bailout. The IMF more than doubles its rescue program after Egypt agrees to float its currency, the pound losing more than a third of its value in one day. Plus, a US tech stock valuation is getting frothy. We discuss that as the market cap of the Nasdaq Composite blows past the size of America's economy. It has just gone 8 a.m. across the Emirates. It's 3 p.m. here in Sydney. I'm Heidi Stroud-Watts. Let's get you straight to how markets are shaping up as we get into here in Asia, the latter part of this Thursday session. It has been pretty buoyant so far. We have really seen Asian stocks here gaining across that, tech in particular being well supported. But so much of this has been on Fed Chair Jay Powell's comments about rates likely to decline this year. He was still very cautious when it comes to the timing and to the magnitude as well. We had a little bit of extra Fed speak around that with those comments from Neil Kashkari, not adding too much that's new, but certainly some reassurance for broader markets and propping up sentiment. S&P futures looking a little bit softer. We are seeing the S&P 500 back above that 5,100 level. So still looking pretty peaky there. Nasdaq 100 futures also a little bit on the back foot, given how much of a gain we've seen in particular for that sort of, I guess, divergence that we've seen in the Mag 7, right? Apple, of course, in the previous session was really the biggest laggard and weighed more broadly across that index. We are seeing tech as really the leading source of the gains that we're seeing across the Asian session in this Thursday Asia session, I should say. Brent crude, taking a look at that, we're holding that advance largely on account of the US gasoline drawdown. We saw, of course, that significant stockpile decline in the US, and that comes ahead of the peak US driving season as well. We're pretty close to the near to the highest levels since November on that, and also getting some support from the Fed that they'll cut interest rates this year. That's also helping aid sentiment when it comes to crude as well. We are seeing Brent trading just under that 83 barrel mark there. Also, quick note on iron ore, we're seeing, of course, it has been a few weeks of sort of downside pressure, but clearly some investors are paying attention to Beijing policymakers across the board, really trying to drive home the message that they are confident that around 5% is possible for economic growth this year. Let's take a close look at how markets in Asia are faring. Avril Hong is with us in Singapore. Avril.
Yeah, Heidi, we're seeing Asia equities under pressure today. I mean, Jerome Powell has removed some of the uncertainties for the markets, but if you look at the way stocks are performing, you wouldn't think that was the case. The Nikkei leading the declines, and it's fallen by the most since the middle of February. Much of this has to do with the anticipation of the BOJ liftoff. I'll get to that in a bit, but we also, in the past hour or so, got China trade data, and it showed that export growth jumped. This is an encouraging sign for the demand for Chinese goods, but if you look at how the CSI 300 or the Hang Seng are performing, they are, that negative sentiment is coming through, and that is particularly feeling the drag from healthcare as well as tech stocks with geopolitics in the mix. Let's flip the board and take a look at what we're seeing on dollar yen, because it has dropped to the lowest since month ago, and this has got to do with the wage growth data that we got earlier in the session, showing the acceleration to the fastest clip since June last year, but also that Bloomberg scoop that showed us that some government officials are giving a tacit green light to BOJ participants or board members for a March or April move, because they see promising prospects of the wage hike. So that's why we're seeing dollar yen moving as well. Central bank is very much in focus today. Heidi.
Avril there in Singapore. Things are starting to turn a little bit when it comes to the direction for Asian equities, but take a listen to how we started this session. Fed Chair Jay Powell really reiterating to lawmakers that the US Central Bank is in no rush to cut interest rates. In his testimony before a House panel, Powell said policymakers need more confidence that they've won the inflation fight.
We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
For more, let's bring in Bloomberg's MLab strategist Mary Nicola. So, it is still very much wait-and-see mode for the Fed. There wasn't nothing overtly new that came out of that testimony. What do we see in the way that investors really reacted?
It's clearly about that no news is good news, no new surprises is good. There was obviously some sort of hawkish tilt that the market was concerned about. And so now that the Fed has just reiterated that the stance that they're going to exercise patience, it just means that the focus turns to data dependency. And of course, the onus goes on the CPI data that we're going to get next week. So that will be the key thing. And then, of course, will it show that is January, was it just a fluke, or are we going to see a continuation in the increase in CPI, or does the downtrend continue, which will then give way for the Fed to actually start cutting rates? But the fact is that there, with no major surprises from Fed Powell's testimony, that obviously offered a big sense of relief for the markets.
It was a big session for banks, right? We had obviously the NYCB equity float, but also equity raise, I should say, but also potentially the scrapping of the capital plan for large US lenders.
Yeah, if we go back to when it initially started and how and what the reaction was, the concern was about bank profitability, that they won't be able to lend out as much as they could. And obviously that, especially with a lot of the big banks in pretty good shape, now they've been given leeway, so it should continue to support banks, especially if it really does come through. Obviously now they're still in the early stages and discussing it, and that was the key surprise for the markets from Powell's discussion was that. But at the same time, it's still in the early stages, but if it comes through, it should still continue to be supportive for a lot of bank stocks.
Bloomberg's MLive strategist Mary Nicola there with us. Let's bring in Ecognosis Advisory CEO Andrew Ferris joining us. Andrew, always great to chat with you, of course. As Avril mentioned at the top, firm focus is on central banks. You make it sound like the reasoning behind these policy decisions or the incremental movement towards decisions is a bit nonsensical.
Basically, yes, in the sense that as we have heard, there is nothing new in Powell's announcement, and all he says is I want inflation to be on a firm path to 2%. Inflation right now, it is still very much with a number 3 in front of it, and we have to see what the CPE is going to tell us. And for the rest of the central banks, it's a completely different story. The Japanese are planning to increase interest rates. People's Bank of China, they increased very marginally, and then the big announcements were about releasing more funds through decreases in reserve requirements. And the European Central Bank is following more or less the same path as the Fed. So we have 2 major banks saying, we may increase, we may decrease, and of course we have 1 major bank says, well, perhaps we're going to cut, and 1 other major bank saying, well, basically for the time being, we're doing nothing. So it depends where you're looking at. And also, in the case of China, we have an issue of deflation, not inflation.
Well, so let's tackle each of those sort of on their own merits, right? Let me start off with the Bank of Japan, because there's been a lot of pretty heavy repositioning around, whether lift-off, whether the trigger gets pulled sooner rather than later. MUFG, for one, thinking that this month might be the month for the BOJ to move. The wage data came in better than expected. Do you think when it comes to the reflationary mindset that they could potentially start to hike?
Yeah. Let's forget the Bank of China. I'll try that again. The BOJ, for a long time, has been saying we want more inflation, but we want more inflation led or created by a special factor, and that is increasing wages. So here we have a central bank that wants to see higher inflation, and that's why it kept interest rates very, very low. And now they are observing very carefully what's happening to wages, because of course they don't want this to grow completely out of hand. It's a slightly surreal view to say, yes, we want more inflation, but then once we are sort of getting it, then we will begin to increase interest rates after we kept interest rates very low in order to get higher inflation. For the men from Mars, we'll say, well, come again, lead me through this again very, very slowly so I can get the idea. But the markets clearly have done it, because the Nikkei has absolutely flown.
Andrew, I want to move on to China, because I always do enjoy your views on China and what regulators are attempting to do. They've come out and defended around 5% as being utterly attainable. Investors maybe at least today showing a little bit more conviction, but How do you think this winds up? Because it is a bold target if they're not planning to follow it up with significant stimulus.
Yeah, it's very easy to be critical when it comes to very broad measures and very broad approaches. One thing that we could have had more was to say we're going to hit 5%, and here is how. X% through investment, W% through increases in exports, and Y% through other, let's say, reform factors. We didn't get that. And we did get also, inflation is going to remain approximately the same, slightly higher, and China right now has got a major problem with deflation, which of course reflects whatever is happening in the property market and elsewhere. The PPI, the CPI, and the property sector are all nearly negative. So, we would have needed a little bit more idea why all this is going to turn out positive, reflecting what's happening in the rest of the economy. And of course, in terms of specific policy measures, we've got nothing more than simply spending more money, which is fine. Incidentally, defense budget went up substantially, and China is now possibly the second biggest spender on defense, following the United States, if I get my numbers right. And this is another factor that helps the economy. But the big but is what is going to actually make the economy hit again the 5% we managed to hit last year, the year before.
At the same time as they're dealing with all these domestic fires, obviously the geopolitical environment is getting tougher too as we head into the US election in November. Do you think this is a priority for Beijing at the moment, particularly as we see even President Biden leaning more on allies to try and make it harder, if not impossible, for China to compete when it comes to AI and chips?
Being a typical economist, I will tell you, thank you very much. That's a lovely question. I will proceed to give you an answer to a completely different one, but I'm not. I'm simply saying, let's take a tangential view. In the case of China, they have to be really watching very carefully a victory by Trump. And this is not that far away. Remember, the elections are in November. If coming near to November, it looks as if Trump might win, the whole range of policies available to China is going to change pretty dramatically, because I do believe that Trump will very quickly impose tariffs, and significant tariffs on China. So this is something that, as you say, the geopolitical factor is not just Biden inviting a circle of containment around China, particularly now with Australia creating possibly the biggest nuclear-led and powered fleet following that of the United States. That's a major development that has been sort of quietly pushed away, but it is actually happening.
Andrew, always great to chat with you. Andrew Ferris, Ecognosis Advisory CEO there. Well, still ahead, Egypt unlocking an $8 billion loan package from the IMF as its central bank hikes interest rates by a record 600 basis points. We have the latest next. This is Bloomberg. Egypt and the International Monetary Fund have agreed to more than double the country's rescue program to $8 billion. Let's get the details from Bloomberg's Ziad Daoud, who's our chief emerging markets economist. So how did the deal get reached, and what are the implications in terms of the next steps?
Well, yesterday was a big day for Egypt. Basically, it did three things. In the morning, it raised interest rates by 6 percentage points. Shortly after that, it floated the currency, and the currency weakened by 38%. And then a few hours later, it sealed the deal with the IMF, in which Egypt would receive a loan of about $8 billion, and in return, it will implement a set of policies. These policies include the flotation of the exchange rate, the raising of interest rates, the cutting of public spending, and a slowdown in infrastructure spending. So, big day for Egypt yesterday, which ended with the IMF deal.
The mega hike was really the most unexpected aspect, right? Does that sort of shot of confidence become a long-lasting one?
Well, I think the whole set of moves were sort of expected. And I think there are two catalysts that basically trigger these set of moves in Egypt. The first one is that the fact that Egypt was actually running out of money. You could see it by looking at its reserves. You could see it by looking at the foreign assets in the banking system. You could even see it and infer it from the Egypt decision to bring the elections, the presidential elections, forward to last December. So that was one catalyst. And the second catalyst is the fact that Egypt received a big bailout from the UAE in late February. Once that happened, we actually expected three things to happen. We expected a rate hike, we expected a currency float, and we expected a deal with the IMF. And we expected actually all of that to happen before the beginning of the month of Ramadan, which is set to begin around the 10th of March. So yesterday's moves were quite big, but we sort of anticipated them.
What are the possible risks now going forward?
I think there are a couple. I think the first set of risks is basically related to the side effects and the aftermath of yesterday's decision. You know, Egypt already has inflation at near 30%. When it devalues the currency by about 38%, that will have an inflationary impact starting from a high level. And the second risk is the implementation risks. Egypt says it has moved to a floating exchange rate, but we heard that before. In 2016, Egypt said this was moving to a flexible exchange rate. It didn't. In 2022, it said it was moving to a durably flexible exchange rate. It didn't. I think there is more commitment this time around, simply because the IMF is more adamant on a flexible exchange rate, but that's definitely a risk given Egypt's track record.
Bloomberg's Ziad Daoud, our chief emerging markets economist, there with us with the latest on Egypt. Well, the US military says 3 people have been killed in a missile strike on a commercial ship in the Gulf of Aden. These are the first crew members killed since Houthi militants started attacking commercial shipping in one of the world's busiest sea lanes. Let's get some more from Bloomberg's Paul Wallace. So, Paul, what do we know about this attack? And we have seen a response too.
Hi, this was very big news yesterday. So since the Houthis started attacking commercial vessels and warships in and around the southern Red Sea in mid-November, they hadn't actually killed anyone. And that was that changed yesterday. The U.S. says that at least 3 crew members of a commodity carrier called the True Confidence died yesterday when a missile hit the ship in the Gulf of Aden near the coast of Yemen. It's unclear what the U.S. will do. The U.S. and the U.K. have been striking Yemen to try and destroy some Houthi positions pretty frequently for most of the past 2 months. The U.S. has said that while those have degraded the Houthis' military capabilities, they didn't expect them. They didn't expect it to be able to say with confidence that the Houthis were no longer able to attack ships for a while. It's possible that the U.S. now decides to step up things in light of these deaths. The other thing to mention is that the Houthis said this was a U.S. ship. It wasn't. It used to be owned by a U.S. investment company, Oak Tree Capital Management, but it didn't seem to have any obvious or direct connection to the U.S. at the time that it was hit in the Red Sea. And this goes to show that almost no ships are safe. The Houthis might have just been confused and they simply had the wrong information. But either way, clearly the southern Red Sea is very much still a danger zone.
We are hearing about another ship sunk by a Houthi missile that may have severed Red Sea cables. And as you say, there may have been confusion in some of these instances. They have said in the past that they're targeting Israel-linked vessels. What more do we know? And I guess, you know, if a ceasefire does proceed, does that mean we could see a little bit of a let-off in this situation as well?
That's a big question, and the Houthis do say that they'll continue their shipping attacks until Israel pulls out of Gaza and stops its war against Hamas. However, there are plenty of people that think the Houthis have almost been surprised by their own success, by their ability to effectively shut the southern Red Sea to at least Western shipping companies, if not companies from across the world. There are certain things that the Houthis want beyond what's going on in Gaza. One of them, for example, is to get more recognition internationally. The Houthis are a militant group, and while they've controlled large parts of Yemen, including the capital Sana'a, for about a decade, they aren't recognized by the vast majority of the international community, including the West. And they may decide to use what they're doing now as leverage to get that recognition.
Bloomberg's Paul Wallace there in Dubai. Much more ahead. This is Bloomberg. Let's get you up to speed with some of the corporate stories on the Bloomberg terminal that we're tracking. The Kuwait Investment Authority, which manages more than $800 billion in government funds, is poised for one of its best fiscal years on record amid a broad market rally. Bloomberg understands that more than 50% of the KIA's investments are in the US, with last year's surge in the S&P and Nasdaq driving double-digit returns at the sovereign investor. That marks a rebound from the previous year when returns were flat. US crash investigators have accused Boeing of failing to cooperate in the inquiry into a mid-air blowout aboard a 737 MAX jet. The chair of regulator NTSB told a Senate committee hearing that it's, quote, absurd that Boeing has not provided all the information sought by investigators. Boeing hit back at the highly unusual rebuke, saying it's doing everything it can to assist the inquiry into the Alaska Airlines incident. The US is said to be pressing allies to further tighten restrictions on China's access to semiconductor technology. The Biden administration's latest push is aimed at plugging holes in export controls, but sources say the effort is drawing resistance in some countries, including the Netherlands, where the US wants ASML to stop servicing chip-making equipment already owned by Chinese clients. In banking news, Deutsche is said to be cutting the bonus pool at its investment banking division by more than 10% after a slump in deals and a slowdown in trading. Sources say some of the deepest reductions are hitting staff advising on M&A. We're told the overall bonus pool will shrink by about 5%. Bank of America's CFO says the lender's investment banking unit is on track to report first quarter revenue growth of as much as 15% from a year earlier, with sales and trading flat. Speaking at an RBC Capital Markets conference, Alistair Borthwick said the bank's markets unit is looking to match what was close to a record for revenue a year ago. All right, take a look at trading in Asia. We started off very positively on the back of some of a relief rally, I would say, with the Fed Chair Jay Powell's comments about patience, but also a reassurance to markets that lower interest rates are on the way. We are seeing broad upside. If you take a look at the Asia Pacific markets, they're about 0.3% higher, but really quite a bit of weakness coming from Japan in the session today. A little bit of dollar strength there weighing on sentiment. This is Bloomberg. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Stocks gain as Fed Chair Jay Powell says he still expects US interest rates to fall this year. Meanwhile, investors are on watch for a rate decision from the ECB today. The $8 billion bailout. The IMF more than doubles its rescue program after Egypt agrees to float its currency, the pound losing more than a third of its value in one day. Plus, US tech stock valuations getting frothy. We discussed that as the market cap of the Nasdaq Composite blows past the size of America's economy. It has just gone 8:30 a.m. across the Emirates. It's 3:30 p.m. here in Sydney. I'm Heidi Stroud-Watts. Let's get you across markets. And what started off as a pretty buoyant day here in Asia has turned decidedly mixed. There was some reassurance, a confidence boost from that congressional testimony from Fed Chair Powell, really not adding a great deal more colour in terms of market expectations, but that reassurance of lower interest rates being on the way was kind of the key takeaway. We also had a little bit of optimism coming through from the confidence that clearly is trying to be instilled by Chinese policymakers policymakers across the board that message that around 5% inflation target, really seen as being overly ambitious without significant policy support, is still attainable according to the NDRC. We also heard from the PBOC that there is further room for easing when it comes to banks' RRR levels as well. Take a look at how US futures are shaping up at the moment. We're seeing a little bit of weakness there when it comes to the S&P 500. We're sitting above that 5100 level, though, after the recent gains that we've seen in the past few sessions. The Nasdaq 100 futures also a little bit on the back foot. We see that drag coming through from Apple. More details in our big take today in terms of the losses stemming and the investment stemming from that now canned car project, and also some of the other woes just engulfing Apple at the moment, including those pretty dire numbers coming out of its sort of China numbers as well. Brent crude there, we're just under $83 a barrel there, pretty close to the highs that we saw in November. A lot of this is really on supply concerns out of the US. We had a significant number of, when it comes to the stockpile drawdown for US gasoline reserves, and of course all of this coming ahead of that peak US summer driving season as well. So that supply side is weighing more when it comes to the oil patch story. A quick mention of iron ore. When we're talking about China and perhaps a little bit more optimism for investors today, you can see that being expressed in some of the industrial metals, as perhaps there is some hope that there is more policy support ahead for property and construction. Let's take a look at how some of these other markets across Asia are doing at the moment. Avril Hong is with us in Singapore. Avril.
Yeah, Heidi, we're in focus, on watch for the BOJ, right? And as we see that wage growth data that came in earlier today, that kind of feeds into the narrative that it will drive inflation, help the BOJ towards its exit. We're also hearing Bloomberg reporting that some government officials are supportive of a BOJ move in March or April. So it is a BOJ play we're seeing across assets. Dollar yen lowest in a month. The Japanese banks doing well. Bonds coming under pressure. Let's flip the board and take a look at what we're seeing in China, because in a way we're seeing a PBOC play after the governor yesterday, Pan Gongsheng, said there's room for more RRR cuts, a reserve requirement ratio reduction. That actually helped to reaffirm the market expectations of further easing from the Chinese central bank, and that helped that bond rally, particularly on the 10-year today. That rally is taking a bit of the breather, but we're still seeing investors piling into the long end of things. If you take a look at the 30-year, for example, so much so that we're seeing the 2 and 30 on the yield curve, the flattest that we've seen on record. So central banks, as I say, very much in focus today. Heidi.
Avril Hong there in Singapore. When are they ever not in focus? But yes, I know exactly what you mean, particularly on the day of an ECB decision and so much noise around the BOJ. But also, we're watching our emerging markets very closely, with Egypt and the International Monetary Fund agreeing to more than double the country's rescue program to $8 billion. That deal was unlocked after Egypt hiked rates by a mega 600 basis points and allowed its currency to float, sending it down as much as 38%. Let's bring in Yap Mayer, who's the Managing Director and Head of Equities Research at Arqam Capital. So let me start off with what we've been talking about in terms of the developments for Egypt. That big, I guess the size of that hike might have been one of the more surprising aspects of this. How long does the confidence injection last here?
I think it will last at least several years. Our basic view is that the currency at the 50 handle will appreciate from the current levels, as we saw in 2016. So you have a stable currency for at least several years. And that's also, on top of that, we expect several tens of billions of dollars to arrive in the country on the back of the high T-bill rates that's being offered, as well as deposit rates are being offered of around 30% for the first year, 25% the second year, and 20% the year thereafter. So it kind of shows you where interest rates will be heading the next few years. So this is a very interesting risk-adjusted return for a lot of foreign investors. So that's why I think we're going to see several tens of billions of dollars coming into the country. As a result of which, the backlog is already starting to be cleared much faster than the 2016 scenario, where it took several months.
We're still waiting to see when the dust settles what happens with the currency, right? Do you expect there is still further volatility to come?
I think it's overshot already, so we'll have to see the next few days, obviously, how it evolves. So we think the real effective exchange rate, if you were to look at 2016, already the 45 handle would have put you at the same trough level as that year, right? So we're already overshooting the 2016 scenario in terms of real effective exchange rate. And that puts you in a good territory. So that's why we think the currency will probably appreciate a little bit from the 50 handle that we're currently seeing.
Yep, as we see a pretty stable outlook when it comes to the US, at least from the monetary policy front. We've got the ECB decision today. In Asia, obviously all the focus is on what the Bank of Japan does and where China's economy goes from here. Across the spectrum, where do you see opportunities for investment, particularly as across global markets, valuations are still pretty peaky?
We see a lot of opportunities. Obviously, within the GCC, we see a lot of growth in Saudi and UAE. A lot of the mid-cap names are obviously doing extremely well on the back of that. And they align themselves with the PIF, which is driving industrial policy making in the country. Similarly, obviously, one of the sovereign wealth funds is driving the changes happening in Egypt. So there's a lot of companies that actually will benefit from this, particularly, for example, a stock like TMG in Egypt, which is going to kind of capitalize on all the changes happening in the North Coast as well as projects in Saudi Arabia. So this is how we play the equity strategy. A lot of growth momentum in the UAE and Saudi. And obviously the valuations in Saudi have kind of crept up, that's for sure. But the growth momentum is very significant. We're underweight Kuwait and Qatar, so this is not where we see the opportunities. And then obviously, where we see a lot of opportunities is obviously the fixed income space in Egypt. So the Eurobonds, we think there's significant room still to further tighten the credit spreads. We think the next target will be to kind of reach the spreads that Turkey is offering. So that still gives you a 2% of reduction in credit spreads. And particularly long end is still trading below the par handle. So that's an opportunity. And the local T-bill market, I think, is a very attractive allocation for international investors.
I wanted to get your views on the privatisation plan by the Dubai government. Obviously, we saw enormous appetite for Parkin. Was this surprising to you, or does it give you an indication of how much activity there could be to come?
There's a lot of appetite for new IPOs. I mean, Saudi Arabia is doing probably 30 IPOs this year. Dubai unveiled its 6th IPO out of a 10 plan. So this is an interesting one because it's the manager of on and off street parking. It's IPOing at probably at the top end of the range. That implies at 19.2 times earnings multiple on trailing pro forma numbers, and it gives you a dividend yield of 5.25. Now, to size that up versus Salik, which is the toll gate operator, which is a similar business model, is trading at 20% premium to that. So I think it's priced at a 20% discount to the most comparable peer. So I think there's going to be a good aftermarket performance. Moreover, we think it's a very attractive long-term investment because parking rates are now only 50 cents to $1 per hour. If you compare that to international cities, obviously there's a huge upside. Not in the immediate future, but in the next the next 5 to 10 years, I think parking rates will have to go up when the city develops vertically. At the same time, the number of paid parkings will still increase every year by over 2% per annum, as there's more unpaid parking spots than paid parking spots in Dubai.
What other beneficiaries do you see of this more favourable macro backdrop?
Sorry, I didn't get your question.
What other beneficiaries or what other investment ideas, I guess, do you see around the more favourable macro backdrop for Dubai?
Oh, there's many names that you can play. Obviously, the population growth is significant, right? The population growth will be around 60% in the next 16 years on its own, right? So a lot of companies will benefit from this. So there's a lot of companies that all the listed space in Dubai pretty much benefits from the population growth, obviously the high GDP growth, even though a lot of the names are kind of utility names. So they provide you the dividend handle, but at the same time also a call on the growth of Dubai. An example, by the way, is Emaar Dev, for example, Emaar Development. They see higher off-plan sales than last year, which was a record. So they continue to see significant growth momentum in the Dubai market, with the stock offering still a very low valuation. So there's plenty of opportunities in our markets.
Yep, really great to have you with us, Jaap Meijer, who's the Managing Director and Head of Equities Research at Arkham Capital. Donald Trump has challenged President Joe Biden to a debate just hours after his final Republican rival, Nikki Haley, dropped out of the race to become the GOP presidential nominee. Trump's call comes ahead of Biden's State of the Union address due later today. Let's get some more from Bloomberg's Bill Ferries. And, Trump spent the primaries avoiding debates with his Republican opponents. Now he seems emboldened. He wants to have them with Biden. Why the change in tactic, if there is anything predictable or kind of, a way to reason this? And what are the chances we'll actually see this happen?
Right. Donald Trump had 5 opportunities during the Republican primaries to debate his opponents then. He passed on them all, despite being goaded by many of his former opponents, talking about people like Chris Christie and Nikki Haley, who said that he should have been there. Now he does want to face off with President Biden. It is likely to happen at some point. I think President Trump really feels that these debates will give him a much-needed boost. I think, though, we're not going to be seeing any of those debates till late in the campaign. The Commission on Presidential Debates, which typically schedules these, has 3 on the calendar, but those are all in September and October, when Americans, after the Labor Day weekend, usually start paying a lot more attention to politics. So we're obviously many, many months away from there. So I think it's going to be a long 6-7 months before we see these 2 men on a stage together.
It's been a pretty triumphant week for Donald Trump, right? Both legally speaking and the end of Nikki Haley's bid. Are there any other hurdles? Does he face any other legal hurdles going forward?
Well, he's just a couple weeks away from probably officially clinching the nomination to be the Republican candidate. But the biggest hurdles he faces, one, are the court cases that are still outstanding. He's facing four major cases with 91 criminal counts against him. So that's going to be playing out throughout the campaign. The other big hurdle he has right now is money. He needs to raise more money to run this general election campaign. The last filings we have from the campaigns at the beginning of February showed Trump's campaign with about $30 million in the bank. President Biden had about $130 million in the bank and has continued to set records from what we hear from the campaign. So Donald Trump is going to be looking for money. He's going to be spending a lot of time talking to big donors and trying to get the small donor base that he's depended on in the past fired up about this election.
Bloomberg's Bill Ferries there. Always great to chat with you. Plenty more ahead. This is Bloomberg. Senegal's postponed presidential elections will be held later this month. That's after the government backed a new date, which will see voters go to the polls before President Macky Sall is due to step down. Let's get to Bloomberg's Andira Oganga, who joins us from Kigali. And Andira, Senegal has been really in a state of limbo. So does this create a bit more certainty?
It really does, Heidi. It's such a sigh of relief for many people in Senegal who now know for sure that the constitutional order is going to be upheld. And this is because the Constitutional Court ruled against the recommendations of the National Dialogue and said elections must be held before an incumbent leaves office. And so on the 24th of March, 19 candidates that had been previously validated by the court will be on the ballot. Shortly after this announcement, we saw President Macky Sall dissolving the government and appointing Sidiki Kaba as the new prime minister to allow his chosen successor, Amadou Ba, enough time to focus on the elections. We are also seeing that he's introduced the amnesty bill to pardon all offenses, particularly that stemmed from political upheaval since February of 2021. What's not clear is if the opposition leader, Ousmane Sonko, will be pardoned under this bill.
We're also watching Ghana, obviously Egypt in the headlines for the finalisation of its deal. But bondholders, when it comes to Ghana, are asking for a sweetener. Does this risk potentially that deadline?
It really does, because what bondholders want is they want Ghana to mirror the Suriname deal, where they introduce a value recovery instrument where if the nation becomes oil rich, they pay out. The same proposal applies to Ghana. If their economic growth accelerates faster than IMF projections, then their interest payments will increase. And, you know, their economic projections from the IMF is 2.8% this year, and then growing to 5% in 2027 and 2028. This is a deal that the Ministry of Finance is against, because their debt levels are really high, 109%. Upon completing domestic debt restructuring, it will be down to about 72% in 2028. And for them to hit the IMF target of 55%, bondholders must take haircuts of about 40%. Now, what Eurobond holders are saying is they can take between 25 to 30% with a value recovery instrument. So now Ghana is back between a rock and a hard place. Either they reach an agreement with their private investors, or they risk missing the next disbursement of the $1.8 billion IMF bailout package.
Bloomberg's Ondira Oganga there. Well, Nigerian tycoon Tony Elumelu, whose firms control 15% of the nation's electricity generating market, is urging the government to reform the power industry to revive the struggling economy. Speaking to Bloomberg, he also discussed listing Transcorp Power on Nigeria's stock exchange.
We are not necessarily looking for capital at this point in time, but want to, consistent with our philosophy of African capitalism, want to democratize wealth. And so what we did was take the stock to the market, create liquidity, and give people the opportunity to trade the stock, to own the stock, and to participate in the prosperity that we're creating at Transcorp Power PLC. In future, if we need to grow business further, go to the market to raise capital directly.
Yeah, I was actually going to ask you about that. I mean, if this is the first step, what would be the next step then if you do need to raise more capital for the company?
If we did need to raise more capital for the company, we'll go to the market to say, now we want to raise capital. So this is first step. And second step, but we'll do so when we need capital for expansion and capital to do other things. But at this point in time, business is good.
What, in terms of funding, would you need? I mean, what is the goal here? Because right now, I mean, the firm is listed at a $1.2 billion valuation. Do you think that is adequate valuation for the company, or are you hoping maybe to raise even more?
I think for us, it's all about democratizing wealth and creating access and prosperity for all. We listed at about $1.2, $1.3 billion. And same day we gained 10% market appreciation. Yesterday we gained another 10%. So that's the market is saying maybe we're too prudent in the valuation. But what's important for us is the value that we create. Transcorp is all about improving lives and transforming Africa.
All right, let's take a look at this chart, putting the AI-fueled rally in tech stocks into a little bit of perspective. The sheer scale of this, $27.5 trillion. That's a market cap of tech stocks on the NASDAQ Composite. It is now equal to annual US GDP. The aggregate market cap is now equal to US GDP. It comes as these soaring valuations really raise questions about whether tech stocks are stretched amid the AI boom. Let's get some more on this. BI's senior technology analyst Mandeep Singh joins us in Singapore. So, you know, it is a question that we constantly ask. But if you take a look at numbers now, are valuations, at least when it comes to mega cap tech, looking stretched?
Well, so when you look at, the earnings for a company like NVIDIA, clearly, it's been growing at almost a 50% CAGR over the last 3 years. And you have to ask yourself, are these peak earnings or they keep growing at that pace? And if they keep growing at that pace, then they could grow into the valuation. But my sense is history tells us, you can't keep growing at 50% when you are at the scale that NVIDIA is at. And that's where the valuation multiples look rich to me. But clearly, they have visibility for next year. And that's why that $100 billion in data center revenue looks achievable. Beyond that, it's a growth rate that everyone is trying to figure out whether they grow 30% or they grow 20% or 10%. And the valuation multiple will change according to that.
We've seen a number of insiders, 2 directors most recently, cash out of NVIDIA. Should this be a warning sign that we're starting to peak, given these ever higher expectations?
Yeah, look, I mean, what they've done over the last 2-3 quarters is every time they come out, they not only beat their numbers, they raise the guidance by 30-40%. Now, that looks increasingly unlikely given what we have seen already, with the estimates going up to the point that the expectation is they will double their data center revenue to $100 billion this year. And that's where I think the prospects of upside surprise look pretty slim to me from here on. Yes, governments are buying more chips. There are new types of buyers that are emerging beyond the hyperscalers that have been the prominent buyers of NVIDIA's chips. But I still think the upside that we have seen in the last 3 to 4 quarters, that was probably the best they had. And going forward, it'll be a lot kind of muted in terms of the upside to their guidance.
Bloomberg Intelligence Senior Technology Analyst Mandeep Singh there joining us out of Singapore. Well, that is just about it from me. There is plenty more still ahead with Jennifer Zabasaja, who joins us in Johannesburg for your next hour as we count down. Of course, we've got the ECB decision, also watching these markets in Asia trading a little bit sideways now after what had been a positive start. Some good news, though, driving the narrative out of China with those export numbers jumping in a rare positive sign for the economy. This is Bloomberg.
This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Stocks gain as Fed Chair Jay Powell says he still expects U.S. interest rates to fall this year. Meanwhile, investors are on watch for a rate decision from the ECB later today. The $8 billion bailout, the IMF more than doubles its rescue program after Egypt agrees to float its currency, the pound losing more than a third of its value in one day. Plus, are U.S. tech stock valuations getting frothy? We discussed that as the market cap of the NASDAQ composite blows past the size of America's economy. It is just past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja. Good to be with you today. Let's take a quick check on where markets are right now as we join you. Clearly seeing a bit of softness there across the board, but still we're seeing U.S. equities still remaining at their record levels. If we take a look at where S&P futures are slightly down about 0.2%, but still the S&P 500 holding above that $5,100 mark. NASDAQ futures also down nearly 0.4%. But we did see the NASDAQ advance nearly 0.7% on Wednesday. Interesting story, though, playing out with the yen. If we take a look at it, it's climbing to a one-month high right there. We see the USD yen cross at about 148.56. And a lot of that is on the back of wage data. But then also we heard from a BOJ board member suggesting that potentially we'll see the central bank raise interest rates this month. Also a quick check on where Brent crude is at about $82.90 a barrel. Slightly down right now, but we did see it rise on Wednesday. Prices got a boost, of course, from Fed Chair Powell's comments, but then also we saw increased tensions in the Middle East and potentially signals of strong gasoline demand in the U.S. So we'll be paying close attention to that. Meanwhile, let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Hey, Avril.
Hey Jen, yeah, in the Asia Pacific, let's focus on China. We're back from the lunch break and we're seeing in the afternoon session CSI 300 and Hang Seng sinking a bit deeper into negative territory. You really get the sense that the NPC might have helped to put a bit of a floor on the equities route, but really doing nothing to help inspire confidence or excitement in the markets. CSI 300 supported though by the gains in the materials as well as the energy sector, and we're seeing that bond rally taking a bit of a breather. Flip the board. Let's take a look at some of the movers in the markets today. One of the things that potentially causing some excitement for Chinese equities participants would be earnings. We did get JD.com and that revenue beat as well as a $3 billion share buyback, which seemed to impress investors, extending the rally from yesterday. But we also have Chinese healthcare firms in the crosshairs of U.S. policymakers, and a U.S. Senate committee has advanced a bill which could bar some Chinese companies from federal contracts. So we're seeing steep losses on the likes of WuXi Biologics and WuXi AppTec. Jen?
All right, thanks so much, Avril. We'll check back in with you in just a few. Meanwhile, let's turn back to our top story. Fed Chair Jerome Powell has reiterated to lawmakers that the U.S. Central Bank is in no rush to cut interest rates. In testimony before a House panel, Powell said policymakers need more confidence that they've won the inflation fight.
I believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
For more, let's bring in Bloomberg's Jill Desis, who has been following the story. All right, so Jill, Powell largely sticking to the script in terms of this testimony, still perhaps moving forward with this wait-and-see approach. How are the markets reacting?
Yes, Jen, well, look, I think that this is exactly what markets wanted out of Powell from this event. Him saying that they're still on track to cut rates at some point this year, that's really all they needed. I mean, Powell's job here was to, try to assuage any concerns that there might even be an uptick in rates, just given the higher than expected CPI data for January. I think he was able to, pretty well accomplish that. And as you've been saying, he's stuck to the script. So that, I think, is all just in line with expectations, which is why you didn't see any kind of major moves off of those comments, just because they were so largely expected. I really think all the news out of this press conference came around his remarks on those Fed regulations on capital cushions for those Wall Street banks. That was really the big surprise here.
Yeah, I mean, that was really the big excitement then, Jill. So can you just dig into what exactly he said and whether or not this was a surprise for many people?
Yeah, so essentially he said that, the Fed could end up reconsidering and, revamping a lot of the rules that it's been talking about for the last year or so on requiring banks to keep larger capital cushions in reserve. So again, Jen, I mean, these are reforms that we've been talking about since the global financial crisis, a lot of, sort of international regulations about how much banks actually have to keep on hand. We saw a lot of this debate ultimately accelerate last year, particularly in the wake of, a lot of banking failures. You're thinking, SVB, that kind of thing. And there's been a tremendous amount of pushback on these types of proposed rules from Wall Street, just because they're worried that if they have to keep too much in cushion, then, that's going to slow the pace of corporate borrowing in particular. That could have larger impacts for the economy. But of course, I think from the government's perspective, it's all about mitigating risk. I think really what's key here, though, is that Powell saying, they're taking into account all of this feedback that they've gotten, this tremendous amount of pushback that they've gotten. And he was saying that the government's plan could be in for broad and material changes. So I think that really kind of changes the conversation around, the Fed versus a lot of these banks on this topic. It's definitely one to look out for going forward.
Yeah, and we're going to have to hear what he says to the Senate committee later today. Bloomberg's Jill Desis. Jill, thanks so much for that update today. All right, let's bring in Altaf Kassam. He's the State Street Global Advisors head of EMEA Investment Strategy and Research. So, Altaf, let's just start here because we did hear Fed Chair Powell really sticking to the script, saying that the Fed is in no rush. And yet you're still of the view that we could potentially see a May rate cut. Why?
Yeah, good morning. I think you're right. Powell did stick to the script. Importantly, he did also kind of rule out any rate hikes, which has started to feature in some people's forecasts. But what we think is going to happen is that we're going to see growth start to slow down, and that's going to be reflected in the numbers. And we saw some PMIs recently, which didn't look so promising. And, you know, that combination of slowing growth with a view that inflation has really been cracked and is coming down and is continuing to come down. And we saw that with the PCE print the other day. And those two together, I think, will be enough to convince Powell and his governors that it's time to start cutting rates. And we think we still think it's a 50-50, and certainly the chances have reduced since we first made that call. But we're still sticking to our guns that May is going to be the time for the first rate cut.
So why aren't the markets then buying into that, Altaf? I mean, is it because we haven't really heard this commentary from the rest of the Fed speak? I mean, because you're an outlier here in terms of the rest of the market.
Yeah, it does feel like what we do need is that now that Powell has spoken, we do need the other governors to kind of get on the same hymn sheet and start singing the same song and coming out with a similar rhetoric that, you know, that it's time to think about rate cuts. Again, it still feels like it's in the balance, and May is still a 50-50. But we do think those growth numbers are going to be the key, and they're going to swing. And when people realize that, you know, the Fed funds and the real rate being as high as it is actually restrictive, we think the market's going to line up behind that as well.
And if that's where the Fed is at right now in terms of your perspective, what does that mean then for central banks more globally? Because, of course, we're going to wait to hear from the ECB. Is it the same outlook that you have for other central banks?
Yeah, it does feel like everyone is waiting for the Fed, the markets, but other central banks as well. And we think the ECB is no exception. And even though it might be prudent to move before the Fed, no one is going to move before the Fed. So today we expect the ECB to pause. The ECB is facing slightly more worrying inflation numbers, but also much more worrying growth numbers. So we think on balance, we could start to see the ECB cut in June. And we see a similar magnitude of cuts, say about 4 cuts this year. So, and similarly, the Bank of England actually has come out a bit more dovish. Andrew Bailey has been a bit more conciliatory in his remarks. So we expect to see easing there as well. Albeit the budget recently may have added a little bit to growth. So it's really everyone waiting for the Fed, everyone lined up behind the Fed. But we do think that it's going to be this combination of inflation coming down, but also growth revealing itself to be weaker than people thought. That's going to spur the first round of rate cuts.
What does that mean, Altaf, in terms of FX? Because we were talking about the yen earlier this morning. Is 2024 then still going to be the year of dollar dominance? Will we see the dollar weaken? I mean, it's sort of everyone's waiting to see really how this plays out, and FX is a really interesting picture of sort of how that might happen.
Yeah, we had expected that we would start to see some dollar weakness before now, but you know, it's been confounded by a few things. One, the exceptional strength of the U.S. economy. Secondly, there's the extreme kind of powerful rally that we've seen in U.S. equities, which has drawn money into U.S. assets and the dollar. And thirdly, the fact that everyone has paused at the same time. We thought the Fed would pause, other central banks would keep hiking. So those three things together mean that we do think the dollar will probably stay where it is, stay range bound. There could be some volatility. The yen is a peculiar animal in itself. Obviously, Japan is undergoing completely different monetary and fiscal dynamics to the rest of the developed economies. And we could see some further strength in the yen as yield curve control, you know, talks about it being relaxed, come more and more to the fore. But it does feel like against the major crosses and against the euro in particular, we will see the dollar stay at least range bound while these three factors, the carry trade, the strength of the economy and the strength of the equity market continue to play out.
And really quick, Altaf, we're also, of course, in the middle of China's ongoing parliamentary sessions. I was looking in your notes, and you said that they've been quite underwhelming. The market's clearly agreeing with that sentiment.
Yeah, unfortunately, I mean, they're never going to get the bazooka out, it feels, and that's what the market is waiting for. but just something that says that, look, we've got your back, we've underwritten the property market, something conciliatory like that we would love to see, and that's what the market wants, and it's just not happening.
Altaf, really great to get your insight today, and thank you for waking up early. We'll wait for that bazooka. Altaf Kassam, State Street Global Advisors, Head of EMEA Investment Strategy and Research. Quite a title there. All right, still ahead, Egypt unlocking an $8 billion loan from the IMF as its central bank hikes interest rates by a record 600 basis points. That and more is up next. This is Bloomberg. Egypt and the International Monetary Fund have agreed to more than double the country's rescue program to $8 billion. For more on this, let's bring in Bloomberg's Ziad Daoud, our chief emerging markets economist. Ziad, you've been following this story obviously very closely. Give us a recap of what exactly we saw on Wednesday.
Well, yesterday was a big day for Egypt, Jennifer. So what happened? We have three things happening in Egypt. First, the central bank raised interest rates by 6 percentage points. Shortly after that, it floated the currency, and then the currency weakened actually by about 38% over the course of the day. And the third thing that happened a few hours later was Egypt sealed the deal with the IMF. The size of the deal is now bigger. It's about $8 billion. And then the terms of the deal is that Egypt will get this loan, and in return, it will need to float the currency, which already says it has. It needs to raise interest rates. It needs to cut public spending. And finally, it needs to slow down the infrastructure spending that has been happening over the last few years. So that was what happened in Egypt yesterday.
That's a long list. I mean, Ziad, considering you've been following this so closely, I mean, were you surprised at just sort of the whipsaw of moves that we saw in terms of the currency, the interest rates, and also what we heard from the country?
I think a lot has happened, but a lot of it was predictable. And I think two catalysts basically led to what we saw yesterday. The first one is the fact that Egypt has run out of money. You can see this by looking at the foreign exchange reserves and look at how much of that is borrowed money. You can see that by looking at the net foreign assets of the banking system, which are deeply negative. And you could even infer that from looking at Egypt's decision to bring the presidential elections forward to December. That was a signal that it didn't have the money to basically last for a few more months. So that was the first catalyst. And the second catalyst is the mega bailout that Egypt received from the UAE a couple of weeks ago. That was a $35 billion. Once that happened, I think our view was, and we wrote that Egypt will raise interest rates, it would float the currency, and it would agree a deal with the IMF, and all of that we expected to happen before the beginning of the month of Ramadan, which is set to start on around the 10th of March. So big moves, but they were largely anticipated given the catalyst that I've just talked about.
Yeah. Bloomberg's Ziad Daoud, our chief emerging markets economist. Ziad, thank you so much for staying on top of this story. Let's turn now to the Middle East conflict. The U.S. military says 3 people have been killed in a missile strike on a commercial ship in the Gulf of Aden. They're the first crew members killed since Houthi militants started attacking commercial shipping in one of the world's busiest sea lines. Let's get more from Bloomberg's Paul Wallace, who is joining us. So, Paul, the concern here, I mean, there's been a lot of concern that something like this would happen, but what more do we know about this attack?
Hi, Jen. Well, the latest news is that 2 of those 3 people that were killed were from the Philippines. That's what the Filipino government has just come out with. There were 23 people on board. 20 of them were sailors, and then there were also 3 armed guards. It is big news. The Houthis have been attacking ships in and around the southern Red Sea and Gulf of Aden since mid-November. But until yesterday, they hadn't killed anyone. And that was, if you like, one silver lining to what they were doing. Some people speculated that was deliberate on their part. They didn't want to escalate things too much. Others said it was just sheer good luck that there'd been no fatalities. The Houthis yesterday said that the ship was American. It seems as if that is false. It wasn't American. It did used to be owned by Oakfield Capital Management, a U.S. investment firm, but no longer. So it didn't have any direct link, if you like, to the U.S. So the Houthis may have simply got it wrong. This is one of the big issues. It's very difficult to determine exactly where a ship is from. Often the managers, the charterers, the owners are all from different countries, and the flag that the ship is flying under may be from a different place. So I think it shows you that pretty much all ships that are going through this area and are near the Bab el-Mandeb Strait in the southern Red Sea are all vulnerable, no matter where the ship is from, no matter where the crew members are from. I think what will be telling us how the U.S. reacts to this. Along with the U.K., it's been striking Houthi positions in Yemen for almost 2 months now on a pretty regular basis. We'll have to wait and see whether they step up those attacks or do something more, because clearly they're not able to degrade the Houthis' military capacity enough.
Yeah, and also the damage that is happening in the region. You know, the other story that we're following closely is about a potential missile from the Houthis that severed Red Sea cables. But there's a bit of questions about what exactly was behind it. I mean, why is there sort of this confusion here?
There is a lot. Through the Bab el-Mandeb Strait at the bottom of the Red Sea and into the Gulf of Aden run several internet cables, and these carry internet traffic to Asia from places like Europe. There has been speculation in recent weeks that the Houthis would try and cut at least one of these cables, because some of them run through Yemeni waters, and waters ostensibly controlled by the Houthis. It is very difficult to do that, however, because they're so deep, and you need pretty sophisticated equipment to be able to do that. Our reporting says that the Houthis have looked into it, but so far they haven't actually cut any cables. However, they did hit a ship a few weeks ago that sunk last weekend, and there's a good chance, from what we've heard from shipping companies and telecoms companies, that ship's anchor, when it was trying to rescue itself, caused a lot of damage some of these cables.
All right, Bloomberg's Paul Wallace in Dubai. Paul, thanks so much for that updated report there. All right, plenty more still ahead. This is Bloomberg.
I think your viewers would understand that in the role I'm in, I'm not going to comment on any one registrant or filer, but many banks are public companies. Those banks need to make sure that they make full, fair, and truthful disclosures to the public so that the public can make their investment decisions. I know we're going to be talking about climate, but it turns out it's connected. They need to make those disclosures that investors take investment decisions on, and make sure they have proper controls to make those disclosures. And but I don't have anything more on this one bank.
But just broadly, you're not concerned about systemic risk that might be emanating from commercial real estate?
Again, I'm not going to comment on one bank and so forth, but
broadly speaking.
Broadly, at the SEC, we are always monitoring markets for systemic risk. And the reason is because investors get harmed when one bank or one non-bank, it could be a bank, it could be a hedge fund, that fails and spills out into the market. I've been it ain't my first rodeo. I was even in the Clinton administration when long-term capital management failed. I was in the Obama administration when we were, cleaning up after the 2008 crisis. And it's always the American public, both investors and issuers, that get hurt. So at the SEC, we do monitor for systemic risk in our remit, and then we work with Secretary Yellen and Chair Powell and share our thoughts.
So to return to this question of disclosures, and this gets us to the news out of the SEC today, you have adopted now climate disclosure rules that have been significantly watered down from what was initially proposed. Scope 3 has been removed. For Scope 1 and 2, companies are essentially going to have to decide whether these climate risks are material to them. It's a pretty significant change. Why not repropose it by just adopting it today rather than opening it back up for comment? Have you opened the SEC up to more scrutiny and potentially more litigation that could come from this?
Well, let's just step back for your viewers just for a moment. What we have here is that today, literally hundreds, maybe 1,000 companies already today are making information about climate risk available to their investors. They're often doing it on the internet. There's sustainability reports and so forth. What we did today is we adopted a rule. We hadn't had a rule previously. And we said these disclosures need to be in your filings, in your annual reports, in your registration statements.
This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Stocks gain as Fed Chair Jay Powell says he still expects U.S. interest rates to fall this year. Meanwhile, investors are on watch for a rate decision from the ECB later today. The $8 billion bailout, the IMF more than doubles its rescue program after Egypt agrees to float its currency, the pound losing more than a third of its value in just one day. Plus, are U.S. tech stock valuations getting frothy? We discussed that as the market cap of the NASDAQ composite blows past the size of America's economy. It is just past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja. Thanks so much for being with us. Quick check on markets before we get to the rest of the show. Clearly softer right now if we take a look at where U.S. equities are. S&P futures down nearly 0.2%, but still holding strong at record levels. S&P futures or S&P 500 holding above that 5,100 mark. The NASDAQ also looking a bit softer in terms of NASDAQ futures, down about 0.3%. That coming even after advancing about 0.7% on Wednesday. An interesting story playing out with the yen, peculiar as our earlier guest Altam Kassam called it. The yen is actually rallying against the dollar today at about 148.53 to the dollar. That amid growing signs the BOJ will end its negative rate policy coming after strong wage data. And quick check on Brent crude right now at $86 a barrel. On Wednesday, we saw it rise by about 1.1%. Prices got a bit of a boost from Fed Chair Powell's comments, but we also saw increased tensions in the Middle East and potentially some stronger gasoline demand data coming from the U.S. Having an impact there. Let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Hey, Avril.
Hey, Jen. Yeah, this week we've been watching out for Powell's testimony. Now that we've got it and there are no hawkish surprises, I think that is helping some segments of the market. We're seeing dollar softer. That might be also contributing to what we're seeing on dollar yen. But as you flagged earlier, it's about that wage growth data that we got today and how that's supporting the case for a BOJ near-term exit from that negative interest rate policy. We also had some chatter surrounding the timing of the exit. Bloomberg reporting that some government officials support a BOJ move in March or April because they see the prospect of wage hike as coming in promising. So dollar yen is hovering at the lowest in a month. But let's flip the board and take a look at EMFX. The rupee has been outperforming its emerging market peers thanks to global bond index inclusion. Today also maybe moving thanks to what we got from Powell as the dollar weakens. This also is the lowest that we're seeing it since September. Flip the board again. Just want to very quickly show you what we're seeing among the shadow lenders in India. That's been in focus as regulators kind of ramp up to constrain the financial risk surrounding them. JM Financial, IIFL, they've been barred from financing certain transactions. We saw double-digit declines yesterday. That is recovering some of the losses from yesterday, but still something we'll be keeping on watch. Jen.
Thanks so much, Avril Hong in Singapore for us. Let's turn now to the African continent. Senegal's postponed presidential elections will be held later this month. That's after the government backed a new date, which will see voters go to the polls before President Macky Sall is due to step down. Let's bring in Bloomberg's Ndiro Oganga, who's been following this story from Kigali for us. So, Ndiro, Senegal has been in limbo. We've been waiting for this date. I mean, does this actually change things?
It changes things, and we have a new election date because the Constitutional Council ruled against recommendations of the National Dialogue Committee that wanted to push elections all the way to June. The court says that elections must be held before an incumbent leaves office. And so on the 24th of March, 19 candidates that had been previously vetted and validated by the court will be on the ballot. Shortly after this announcement was made, we saw President Macky Sall dissolving government and appointing Sidiki Kaba to be the new prime minister and relieving Amadou Ba of his duties to focus on the up-and-coming elections. President Macky Sall has also introduced an amnesty bill that will seek to pardon all crimes committed during the political upheaval period that Senegal has gone through since February of 2021. What's not clear is if the main opposition leader, Ousmane Sonko, convicted of libel charges, will also be pardoned under this amnesty bill.
Yeah, and a lot of people have been calling for that, of course. Ndiro, let's turn to Ghana. We were talking earlier about Egypt. In terms of Ghana and bondholders, they're asking for a sweetener to restructure the debt. Can you talk to us about this? Because this is another country on the continent that's really been bogged down by its debt.
What investors are looking for is for Ghana to mirror the deal in Suriname, where the country introduced a value recovery instrument, where if the country discovers oil, then they'll be able to pay out. In Ghana's case, they want their interest payments to increase if the economic growth accelerates faster and further than the IMF projections. Currently, IMF puts it at 2.8% growth this year, and then growing to about 5% in 2027 and 2028. However, this is a deal that the Ministry of Finance is very much against, because Ghana hit record debt levels of 109%. And after they complete restructuring their domestic debt, they'll be able to bring down that percentage to about 72% in 2028. But to hit the IMF target of 55%, then external bondholders need to take a haircut of about 40%. That's where it gets a little bit dicey, because this external investors say they can take a haircut of about 25 to 30% if Ghana introduced a value recovery instrument. And so Ghana is between a rock and a hard place. Do they have a conversation with their private investors, or maintain their hard stand and risk losing out on their upcoming $1.8 billion IMF package disbursements?
Yeah, and we know that that is not something that the country wants, obviously. Okay, so then what happens now? Because we are waiting for an election later this year. What's sort of the next step in this story?
Like I mentioned earlier, they're between a rock and a hard place. So it's up to the Ministry of Finance to go back to the drawing board. This is almost like a self-inflicted wound. They can have a conversation with the private bondholders and reach a conclusion, because where they are currently, they cannot risk missing out on these disbursements by the IMF. They depend on it to keep the economy going, to keep government functions going. And also they have a very controversial bill, the anti-LGBTQ bill, that has made the international community look at it in a very dicey manner. The World Bank had earmarked $900 million, which could be in jeopardy. So currently, Ghana needs to do everything it can to ensure that it keeps getting the disbursements from the IMF.
Bloomberg's Ndiro Oganga in Kigali for us. Ndiro, thanks so much, as always, for that reporting. Let's stick on the continent. Nigerian tycoon Tony Elumelu, whose firms control 15% of the nation's electricity generating market, is urging the government to reform the power industry to revive the struggling economy. In a conversation with him, I asked him about central bank measures to help the Naira. Take a listen.
What I saw from all the decisions the central bank took at the last MPC, if I were there, those are the exact decisions I would take in this circumstance. So I believe that it's hopefully, let's just continue, let's not relent. Early days, it's just starting. But it seems, one can be fairly and cautiously optimistic that we're getting there on the right track.
So then when do we see the Naira start to stabilize a little bit? Because I hear what you're saying about being patient and waiting, but if you have an investment, it's hard to do that with your money.
I know, Jennifer, it takes God to say that, to answer that. But what I know as a transformation person, the transformation journey takes time. And, it takes time, a few initial pains, but stay focused, stay the course, be consistent, and be sincere and committed to it. What I see, fixing the issues, making sure that interest rate is not negative to the investor, making sure that it's an inflationary situation and that we're contracting as much as possible so that we have fewer Naira chasing dollars, giving confidence to the market that, we have forward, don't worry about it, for this is what we're doing about it, we'll reduce it, and there are plans to doing more. I think ultimately Naira would come down, I believe. When, I don't know, but I am encouraged as an economist and as an investor. I'm encouraged what I see. I believe in the medium to long term, things will begin to normalize. Do I expect any quick fix immediately? It started, but I think it will take a bit of time. Medium to long term, I believe we'll get it right. But the key thing is to get the fundamentals right. Let's get the fundamentals right, not get too populist.
Nigerian tycoon Tony Elumelu speaking with me about the Naira and, of course, his economic outlook. Let's turn to the U.S. Donald Trump has challenged President Joe Biden to a debate hours after his final Republican rival, Nikki Haley, dropped out of the race to become the GOP presidential nominee. Trump's call comes ahead of Biden's State of the Union address. That is happening later today. Let's bring in Bloomberg's Bill Ferries in Singapore following the story. So, Bill, we saw a lot of the primaries where Trump was avoiding debates with all of the opponents that have now dropped off. But now he wants to debate Biden. I mean, are we actually going to see this happen?
Well, I think we will, and you're right. There were 5 primary debates between the opponents to Donald Trump starting in summer last year. Donald Trump refused to take part in any of them. He was leading in the polls and felt, I think, very comfortable staying above the fray. Now it's a much tighter race with Joe Biden heading towards the November election. I think he wants to try to present a contrast with Biden, but you have to go back to 2020 and look. These two men debated twice. There were supposed to be 3 debates until President Trump at the time got COVID. Those were kind of a wash. I don't think when you look back at those, anyone thought that Trump particularly stood out. But there probably will be a chance to see them face off. The Commission on Presidential Debates has 3 debates scheduled. That's not till September or October now. So we have almost 6 months to wait, 6 months of campaigning before we get to that point.
And, there are a lot of people, of course, we're looking at a video of Trump and Biden debating back in 2020. Many people, are talking about how this is really going to be a different election season than we saw in 2020. In terms of Trump and the challenge that he has going forward, I mean, what would you say is sort of top of mind?
Well, you're right. This is going to be one of the longest official presidential campaigns we've ever seen. It's never usually wrapped up this early. One of the big hurdles for President Trump, frankly, is going to be money. Starting February, we know from official filings, President Trump's campaign had about $30 million on hand. President Biden's campaign had $130 million on hand, and he's continued to set records for Democratic candidates at this point. So there's a big money gap at this point. There's also the legal issues that are going to continue dogging former President Trump over the next several months. He's got 4 criminal cases out there, 91 total counts against him, a Supreme Court case that has yet to be decided on whether he's immune from prosecution for acts committed while he was in office. So he's going to be spending a lot of time back and forth from various courthouses. That's also going to distract both from his ability to campaign and will take away some of the funds that he raised during the campaign. We know he's already spent tens of millions of dollars of campaign money helping pay his legal fees. So it's going to be quite a contentious next several months. The advantage, I guess, President Trump has is that there's still a lot of time before that November election to try to raise the cash.
Yeah, and for President Biden, I mean, he has the presidential podium, right? And we mentioned the State of the Union that he's going to be delivering later today. Are we likely to hear him speaking to the domestic audience, talking about anything campaign related, or will it be speaking more to the international audience? What do you think?
It's going to be a very much domestic-focused speech. He's going to try to talk about what he thinks are his biggest accomplishments and biggest challenges ahead. He's going to try to remind the American people of where they've come since 2021 when he took office. Very different world back then, a world where very few people even had COVID vaccines. He's going to try to bring that up. He's going to talk about how he thinks Donald Trump would undercut those accomplishments and goals. So it is a unique opportunity for President Biden to have the stage alone, to talk to the American people without having to engage in a direct debate with Donald Trump.
Yeah, that's right. Bloomberg's Bill Ferries. Bill, thanks so much for that update. All right, plenty more still ahead. This is Bloomberg. Here's a chart putting the AI-fueled rally in tech stocks into some perspective, as you can see right there. The $27.5 trillion market cap of tech stocks on the NASDAQ is now equal to annual U.S. GDP, the highest valuation for the group outside of the pandemic. This is raising questions, though, about whether tech valuations are stretched amid the AI boom. For more on this, let's bring in BI senior technology analyst Mandeep Singh, who's been looking at this very closely. So, Mandeep, a lot of people have different comments on whether we're seeing a bubble, whether this is too frothy right now. Do you think tech valuations are looking a bit too stretched?
Yes, simply because we have a history, 100+ years of history around the multiples these companies, especially the tech sector, has traded at. And when you look at the historical multiples, there is no doubt that the numbers suggest this is almost 1 standard deviations above that historical average. Now, part of the enthusiasm is justified by this multi-year secular trend of generative AI. And there are, a couple of companies that have benefited heavily from that. So that concentration is what worries me a little bit about this run-up, because not every company has participated in this tech rally as of yet.
Yeah, but we've really seen, we were mentioning this, NVIDIA, so much excitement, as we mentioned just a few weeks ago from their earnings. The question, though, is whether or not this will actually last. Do you think this actually has legs? What does this look like going forward?
So what we have seen historically with multi-year secular trends is, they don't go up in a straight line. I mean, yes, there will be a lot of excitement. There will be a big investment phase, as what we are seeing right now, driven by CapEx of the hyperscale cloud vendors. But there will be a period when people will look to validate the ROI on the investment, and there will be a digestion period. And I don't think we are there yet in terms of companies slowing down because of the supply constraints, NVIDIA chips have had. So nobody's thinking about, oh, do I really need to just sit back and see what kind of ROI can I get? But there will come a time when companies will take a pause and they'll just try to digest, the spending they have done and look for ROI and validation points around how does it translate into productivity and, better profitability. And we haven't reached that stage, but I think we are close in terms of reaching that kind of valuation phase.
And you and the team have calculated that generative AI could barrel towards a $1.3 trillion market by 2032. So then what does this mean for the other big tech players? I'm talking Alphabet, Meta, and the others who are benefiting from this.
Yeah, look, I mean, you go back in time, traditionally the value accrues to the companies that have the data, that have the software, and, you know, the front end to really drive that stickiness when it comes to applications. The chip providers will do well because of the CapEx investments, but that's not where you see profitability. So this cycle is somewhat different because NVIDIA, with its gross margin expansion, has shown that they are capturing the bulk of the value. Now, our thinking is, over time, you are going to see the digital ad companies benefit from it, the software companies benefit from generative AI, and that's where, you know, an Alphabet, a Meta, and other software companies such as Adobe and Microsoft and, you know, a number of other software players, even smaller ones, will benefit from the trend. But clearly, you know, it will happen over time, and right now we are in that bubble phase, I should say, you know, just where everyone is clamoring to focus on the hardware side, and no one really is seeing past that hardware phase. But there will be a phase when investors will be focused more on the ads and the software space.
Will be interesting to see how that plays out. Bloomberg Intelligence Senior Technology Analyst Mandeep Singh. Mandeep, thanks so much for joining us. All right, plenty more still ahead. This is Bloomberg. Economists are predicting the ECB will leave interest rates at 4% for a fourth meeting later today. Investors will be on the lookout for any hits from President Christine Lagarde on the timing of the first rate cut. Let's get more from Bloomberg's Alessandra Migliaccio at the ECB in Frankfurt. So, Alessandra, what exactly are we watching out for?
Hi, good morning. Yes, we are waiting to see what the Governing Council will do. As you said, we pretty much know that this time around, they're not going to touch rates. They're still nervous about inflation. Inflation has slowed considerably, but what they're really looking at is wages. Wages have not slowed as much as economists hoped. And so what we think right now, what the market is betting on, is basically that they won't be cutting rates until at least June. But what's important is we have to see, as they've always said at every meeting, the data. So they will be looking at forecasts. They'll be looking at the data that's coming in to see exactly how much they're going to be cutting and when they probably will begin cutting.
And in terms of those forecasts and the data, you know, we're going to be getting a bit of new data that from today. I mean, how is this going to play into their decision making, but also really the rhetoric that we hear from the ECB?
I think basically the ECB is just worried that if they move too soon, then, you know, that could have tragic implications. They could look like they're uncertain. That could spook markets. So they'd rather wait, even if everyone, you know, is starting to tell them, policymakers, particularly politicians, worried about the economies in Europe. They're saying, let's do something. Inflation has slowed, but the ECB wants to take it slow. They're going to look at that data. What they're likely going to see, because we're already getting some of that in, is that inflation has slowed, but underlying inflation is not exactly where they want it as yet. And so we're just going to listen very hard to Christine Lagarde to see what kind of hints she gives us, you know, if it's really likely that they'll cut in June or if she's still a bit shy, and that could mean that they may wait. And also, of course, very, very soon, we're going to start wondering, the market's going to start wondering how much they will cut each time they do cut, likely starting from June.
All right, Bloomberg's Alessandra Migliaccio joining us from the ECB. Thank you so much for joining us. All right, quick check on futures right now and where markets are trading currently. They're slightly softer, as you can see right there. S&P futures down about 0.2%, but still holding above that 5,100 mark. NASDAQ futures also seeing some downside, but still we are seeing a number of these equity indices holding at record levels. Let's also take a quick check on where Brent crude is, because we are seeing crude holding at the highest level since November right now. Brent crude at 82.90, slightly down, but still seeing some upside. Prices got a boost from what we heard from Fed Chair Powell on Wednesday, potentially signaling some rate cuts later this year. There's also increased tensions in the Middle East affecting prices there. All right, stick with Bloomberg. Bloomberg Daybreak Europe is up next. This is Bloomberg.